Good morning, everyone, and thank you very much for joining me. Apologies that I am late. I had to speak with my IT department again. I'm having some issues, but we seem to be sorted out. My humblest apologies there. It's also not the best day to have this. It's not the best day to have the IT issues because at the top of the hour, I want to actually move to the crypto minute and do the crypto. So I'm begging your pardon. I do apologize. My name is Russell Shaw. This is the morning market review, and you are most welcome to send me an email to rshaw@fxcm.com. Today is Wednesday. It's the 6th of April 2022. I just want to bring up our disclaimers, and then I'll try to get a move on so we get some decent analysis in. Hey, Howard. Sorry about that. Yeah, but the IT actually were really fast. I just, for some odd reason, for the last few days, every time I've logged in, it's asking for a verification, and the email that it gets sent through to is to an email box I don't have access to, but I am going to request access to that box, to that inbox today. Hey, Michael, good morning to you. Pleasure to have you on the webinar as always. All right, here's the market commentaries disclaimer. I'll keep this on screen for a few moments. Hey, Jan, good morning to you. So nice to have you on the webinar as always, and thank you everyone for joining. And here's our references: Market Scope 2.0, CNBC, and TradingView. I doubt we'll use TradingView today, but let's just start off with the CNBC morning note, see what the media has for us. So just to let you guys know where I'm reading this from, it's from CNBC.com, just the European morning note, and it's, the headline starts: European stock sets a pullback amid hawkish Fed comments and new Russia sanctions. European markets are set for a lower open on Wednesday against a backdrop of hawkish comments from US Federal Reserve officials and further sanctions against Russia. And this is really important for us because there is a number of Fed officials that are speaking this week, and they're really preparing the market for their hawkish bias. So that's and we're getting the Fed minutes tomorrow as well. Sorry, not tomorrow, today. We're getting the Fed minutes today. Britain's FTSE 100 is seen around 30 points lower. DAX is set to slide 59 points, and France's CAC expected to drop about 28. All right, so we'll take a look at the chart in a moment. Now, Fed Governor Lael Brainard, who is a, she's regarded as a dove, but she's also very influential. She was a candidate for the chair position. It went back to Jerome Powell for his second term, but Lael Brainard was certainly in the running, and she said during a Minneapolis Fed webinar on Tuesday night that the central bank will need to reduce its balance sheet quickly and continue to increase interest rates at a steady pace in order to contain surging inflation. The comment sent major US averages lower and the US 10-year Treasury yield to a new high. And San Francisco Fed President Mary Daly then told the Native American Finance Officers Association that inflation running at a 40-year high is as harmful as not having a job, and assured the group that the Fed is ready to act. Global investors are also awaiting details of fresh international sanctions against Russia after allegations emerged of civilian killings in Ukrainian towns now recaptured from Russian forces. The European Commission on Tuesday proposed banning Russian coal as part of its next round of sanctions. US stock futures were flat in early pre-market trade as investors stateside await the release of the Fed's Tuesday meeting minutes. All right, hoping for further details about the Fed Open Market Committee's plan to reduce the central bank's balance sheet. So I just got a bit confused. Fed's Tuesday meeting minutes. Anyways, the minutes of their last meeting are due out today. That's the main idea, and we just want to see if they contain any new information regarding the we've always referred to QE, quantitative easing. Well, the new sort of buzz phrase is QT, right? Quantitative tightening. So we'll just keep an eye on that. Shares in Asia Pacific declined on Wednesday, tracking overnight losses on Wall Street, with Chinese tech stocks in Hong Kong falling sharply. UBS holds its annual general meeting on Wednesday, while on the data front, the Eurozone's construction PMI readings for March and February's retail sales are due. Beach just written here, the 2-year yield is going higher. Not a good sign. All right, so let's see if we can marry all this information up as quickly as we can. Let's go through to the DAX, and this chart here. So this, I think, is a very menacing looking chart on a technical basis. On a fundamental basis, we've got all the news talking about higher interest rates, a new round of sanctions. There is certainly two factors here that we need to understand on a fundamental level, and one is this: higher rates. Okay, so that's something that we must know on a fundamental level, and we must know this as well: risk premiums. Okay, as market participants, premiums. Let me get this. What we want is effectively we want R. Okay, we want R, which is equal to a rate of return. Let me get this in. Rate of return. Okay, so we require a rate of return. Otherwise, why would we go into the risk markets? We would go into a money market account to just earn what's basically regarded as risk-free. Money market accounts do have risk, but the odds of actually incurring a loss on a money market account are so long that it's basically regarded as risk-free. So the idea is, well, if we're going to commit, say, to the DAX, we need to be compensated for, one, higher rates, okay, because interest rates are starting to be increased. So that's the one thing that we need to be compensated for. The other thing we have to be compensated for is, well, there's a risk here. There's a heightened risk of going into the market, and so we need a premium on. We need a premium just on the. We need a premium on the on our return. So higher rates plus risk premiums gives us our rate of return. Howard's just saying that the sound was gone. Can you guys hear me? Is the sound an issue? Just let me know. Okay, cool. All right, so we've got these things. So these are in flux. We've got to understand these two things are in flux at the moment. There's no stability with regards to the fundamental variables. They're in flux because every day we're getting different news, and that's making life very difficult, because if the rate of return is in flux, well, that equals uncertainty, which is directly related to the risk premium, because uncertainty, if there's higher uncertainty, we want higher risk premiums. Now, what's the big deal about this? So there's a very simple mathematical calculation which is very important to the risk markets. We've done it many times before, and it's the time value of money calculation, and it's simply 1 plus R. Now we can do a webinar on this. I don't want to get into this, but the point is that if R is increasing, which it is, we're saying that it's in flux. Okay. Now you can see this is a denominator. Okay. It's very important that we understand this, because the mathematics here is what's driving the markets at the moment. Okay. So it's a denominator. Okay. And the present value, in other words, the value of risk markets, is what we call a numerator. So there's an inverse relationship. Okay, this is a denominator, this is a numerator. So if R is increasing, If R is increasing, it means that the denominator is increasing, right? And if the denominator is increasing, it's going to put pressure on the numerator, on the present value. So if this is, so if I'm losing you kind of in my explanation, I'm hoping I'm doing it okay. You must let me know, because it's very, very important. We're in flux, okay? We're in flux and our denominator is increasing. Excuse me. And if the denominator is increasing, the present value is decreasing. I'm just going to go and mute for a moment. I'm begging your pardon, I just had a cough there. So there's a pressure. This whole explanation is higher rate, risk premium in flux. That's putting a pressure on our present value. Well, that's what is very concerning. Technically, we've done the fundamentals. Okay, it is the technicals now that are reflecting a potential dead cat bounce or a bear market rally. In other words, what we've got to take a look at is, are we going to get a lower peak? Yeah, yesterday Pete said he's looking at the 148 level or thereabouts, right? Well, that resistance is holding. And that resistance is holding. And if it does hold, well, then we've got to watch for the next lower trough. Because if the next lower trough comes in, that's going to be exceptionally painful for the market. That's where the damage is going to be. Okay, it's not the bear market that hurts. It's the bear market rallies that hurt, and we don't know how many of these we're going to get. So they can sucker. They're called sucker rallies. They can suck us in, you know, multiple times. By the time they finished, we could be significantly poorer. So the idea here is we've got to be very, very mindful of these bear market rallies. Yeah, exactly, sucker striders. And so now the reason that we talking about a bear market rally is because on the fundamental level, the required rate of returns in flux. Okay, there's an uncertainty around that, and that's the trick. Okay, when do we see some sort of stability? Now, if the required rate of return does stabilize, we might get something like this, which would be the ideal sort of scenario in terms of buying in at value. In other words, if we can get a higher trough, okay, followed by a higher peak. Well, there's the bull trend reasserting itself. Okay, so that would be one scenario. However, I'm not sure if that's the way it's going to track. We've got to be very careful that we don't fall off a cliff here. Okay, so this lower peak here, let's just talk about this technically, and then we're going to go to the crypto minute. And apologies just that I'm running late. We've pulled back to the 62% fib retracement. Okay, often the 62% is a significant level, not because of it being a 62% retracement. That's ridiculous. It's because it's a self-fulfilling prophecy. There are a number of traders that view the 62% trade, and their actions are self-fulfilling, right? So this is a 62% retracement at an overlap with support turned resistance. 1, 2, 3, 4, and now it looks to be holding it. This, by the way, support turning into resistance is called the principle of polarity. So we're right at a very important key level. Does that key level hold? That's what Pete said to us yesterday, that 148, right? So that's the principle of polarity right there. So we want to keep an eye on that. Watch for the higher trough. That would be the best case scenario. But if we don't get that, we fall off a cliff. And we've got the RSI under 50. As long as we stay under 50, it's on the bearish side. Now forget about sort of bullish divergences and convergences and reverse divergences and all that stuff. If it's below 50, it's on the bearish side of the oscillator. If it's above 50, it's on the bullish side. and especially we'll look for the extremes, under 20 or over 80. All right, if there's any questions, please go ahead, type those in now. I'm going to conclude at this point, just because I'd like to get the crypto minute in. But if there's any questions, please go ahead and type those in. All right, nothing coming through. I beg your pardon that I was late this morning. I'm going to try and get access to that inbox today. In the meantime, we'll conclude here, and we'll have the crypto minute up next. Thank you very much, guys.